Hello, everyone. I'm so glad you're here, ready to take charge of your financial future. Today, we're diving into smart investing. Unlock the secrets to lasting wealth. Make your money work for you. Understand the rules, play to win. Ready for financial empowerment? Let's start. The key to smart investing is understanding long-term value. It's not about chasing trendy stocks or timing the market. Identify businesses with strong fundamentals and buy at a sensible price. Like buying a house, check the foundation and neighborhood. Ensure you're getting a good deal on a solid investment. Value investing applies this principle to the stock market. Look for companies with a proven track record and growth potential. This approach requires patience and discipline. Tune out market noise and focus on fundamentals. One of the biggest mistakes investors make is not understanding what they're buying. They see a stock ticker go up, they get excited, they buy, and then they wonder why their portfolio is in the red. Smart investors understand the businesses they're investing in. They research the company's products and services and analyze their competitive landscape. They know a stock price doesn't always reflect true value. Sometimes the market gets it wrong. A stock can be undervalued or overvalued. Knowledge is power. The more you understand, the better equipped you'll be. Now, I know what you might be thinking. This all sounds great, Suze, but isn't investing risky? Well, yes, any investment involves some degree of risk. But the key is understanding and mitigating it. Smart investing is not gambling. It's about making calculated decisions and building a diversified portfolio. We're playing the long game, building wealth slowly and steadily, brick by brick. Take control of your financial future. Let's talk about intrinsic value and market value. Understanding these is crucial for any smart investor. Imagine you're at a flea market and spot a beautiful antique vase. You know it's worth more than the seller's price. That's intrinsic value. The true worth based on qualities. The seller's price is the market value. Market value fluctuates based on supply, demand, and trends. In the world of investing, the same principle applies. A company's intrinsic value is its true worth based on its assets and future potential. The market value is reflected in the stock price. It's what investors are currently buying or selling the stock for. We want to find companies whose market value is lower than their intrinsic value. Buy those undervalued companies, like finding a bargain at the flea market. Remember, the stock market is like a giant auction. Prices can be driven by fear and speculation. Don't get swept up in the hype. Popular stocks aren't always good investments. A struggling company might have solid long-term prospects. Focus on intrinsic value. Do your homework. Financial statements demystified. How do I determine a company's intrinsic value? It's not as complicated as it sounds. Think of financial statements as the company's report card. They tell you how the company is performing financially. Spotting undervalued companies. Analyze statements to gauge financial health and growth potential. Look for profitability, strong cash flow, and low debt. Use ratios like price to earnings and price to book. These help assess stock price alignment with earnings and assets. Remember, patience is your superpower. Finding hidden gems takes time. It's not a get-rich-quick scheme. The rewards of patient investing are worth it. Now let's dive into one of the most important concepts in value investing, the financial cushion, your protection against the unexpected. Even the smartest investors can't predict the future. Markets can be volatile, economies can fluctuate. That's why we need a buffer, a margin for error. Think of it like this. You wouldn't drive a car without brakes. The margin of safety is like having strong brakes on your investment portfolio. Navigate those unexpected twists and turns without crashing. The margin of safety is the difference between a company's intrinsic value and the price you pay for its stock. Imagine finding a stunning designer dress at 75% off. That discount is your margin of safety. In investing, we seek similar opportunities. Think of it like baking a cake. You wouldn't just throw all the ingredients together without measuring. The margin of safety is like that careful measuring process in investing, as we build in a margin of safety to protect our investments. Section 4, calculating your margin. A little math goes a long way. How do I calculate this margin of safety? It's not as complicated as it sounds. Compare a company's stock price to its net asset value, or NAV. NAV is assets minus liabilities divided by shares. If stock price is below a NAV, it indicates a margin of safety. Don't get caught in the storm. The market can be an emotional beast driven by fear and greed. Prices can fluctuate wildly, often detached from a company's value. That's why having a margin of safety is crucial. The market is like the ocean, and stock prices are like waves. The waves can be choppy and unpredictable, but the ocean is vast and enduring. We're focused on the long game, riding out those waves. The margin of safety is our life vest during market storms. Section 6. Sleeping soundly at night. The power of a safe margin. The margin of safety lets you sleep soundly, knowing your investments are protected. It provides peace of mind and reduces emotional stress. Investing should be liberating, not stressful. Embrace the margin of safety for confidence and protection. It's your secret weapon for lasting wealth and peace of mind. Now let's talk about the investor. Not all investors are created equal. Each has different goals and risk tolerances. Understand the two broad categories of investors. It's about finding what aligns with you. Think of it like planning a vacation. Some crave adventure, others prefer relaxing. Both are valid ways to enjoy a vacation. The passive investor prioritizes safety and simplicity. They want a straightforward, low-maintenance approach. They're content with steady, long-term growth. Defensive investors prefer a relaxing vacation. They seek a smooth and enjoyable experience. So, what types of investments are suitable for defensive investors? They typically gravitate towards low-cost, diversified index funds and ETFs. These investments provide broad market exposure with minimal effort and expense. Defensive investors also favor passive income, like dividend-paying stocks or real estate. Section 4, the enterprising investor ready to roll up their sleeves. Now let's talk about the enterprising investor. This investor is hands-on, seeking undervalued opportunities. They research stocks, analyze trends, and aim to beat average returns. Higher returns come with higher risks, and they're comfortable with that. Section 5, active stock picking and market analysis. Enterprising investors engage in individual stock picking using fundamental and technical analysis. They identify undervalued companies and refine strategies. Tools like stock screeners and industry reports help make informed decisions. They challenge conventional wisdom. Active investing has risks. The market can be unpredictable. Which one are you? Finding your investor personality. So which type of investor are you? There's no right or wrong answer. Be honest about your risk tolerance and goals. Choose the approach that aligns with your needs. Invest in a way that feels comfortable and empowering. Now, let's talk about a crucial ingredient for investment success. Patience, not procrastination. It's like planting a seed and watching it grow. The market is like a mischievous child, always unpredictable. Smart investors invest for the long haul, riding out the market's ups and downs. Think of investing like running a marathon, not a sprint. Pace yourself, conserve energy, and focus on the finish line. It's about consistency, discipline, and a long-term perspective. Be patient, stay the course, and trust in time. Now, let's talk about the elephant in the room. Oh boy, those pesky emotions, they can be our worst enemies in investing. The market loves to play on our emotions. It wants us to buy high and sell low. But smart investors stay rational. Fear and greed, don't let them control your portfolio. Investing should be approached with level-headedness. Fear and greed can wreak havoc on your portfolio. Fear might make you sell at the worst time. Greed can lead to impulsive decisions. If it sounds too good to be true, it probably is. Have a plan, stick to it. Mastering your emotions, taking a deep breath and trusting the process. Investing is a marathon, not a sprint. There will be ups and downs. Focus on the long term. Ride out emotional waves to reach your goals. Take a deep breath, step back, and remember your plan. You've got this. Long-term thinking, planting seeds for a bountiful harvest. Long-term thinking is about more than just weathering market storms. It's about understanding that the greatest rewards in investing come from allowing your money to compound over time. It's about planting seeds today that will grow into a bountiful harvest in the years to come. Investing is the same way. By adopting a long-term perspective, you're building a solid financial foundation. All right, let's talk about one of the most important principles in investing. Don't put all your eggs in one basket. Diversification reduces risk. If one stock nosedives, you're in trouble. Spread your money across different investments. Think of diversification like building a dream team. You wouldn't want a team full of only point guards. You'd want a mix of players with different skills. Investing is the same way. You want a mix of different assets, stocks, bonds, real estate, commodities, each playing a specific role. Stocks are like high-energy players, high returns but higher volatility. Bonds are steady and reliable. They provide stability and balance. The right mix of asset classes depends on your risk tolerance, time horizon, and financial goals. Younger investors might prefer more stocks, while those nearing retirement might choose bonds. Diversification is key. Section 4. Risk management, protecting your hard-earned money. Risk management is crucial in smart investing. Investing always involves risk. The market can be unpredictable, but risk can be managed. Understand and manage it. Like a seatbelt, have a risk management plan. It's your investment safety net. Protect your money and minimize losses. Setting realistic expectations. Set realistic expectations in risk management. Investing isn't about getting rich quick. Build wealth slowly and steadily. Avoid the hype of hot stocks. If it sounds too good to be true, it probably is. Invest in quality companies with strong fundamentals. Section 6. Weathering the storms, having an emergency fund. Another crucial aspect of risk management is having a solid emergency fund. Life is full of surprises, and sometimes those surprises come with a hefty price tag. Having a cushion of cash can help you weather those financial storms, or worse yet, go into debt. The Smart Investor's Playbook, key takeaways. Congratulations, you've completed a crash course in smart investing. We've covered intrinsic value, managing risk, and key takeaways. Smart investing isn't about get-rich-quick schemes. It's about making your money work. Build a solid financial foundation with knowledge and discipline. Anyone can achieve financial goals with the right mindset. It's your money, your future. Take charge. You're in control of your financial destiny. Don't let anyone tell you otherwise. Take charge of your money and build a brighter future. Knowledge is power. Never stop learning and growing. The world of investing is constantly evolving. New technologies, market trends, and investment strategies are emerging all the time. Be a lifelong learner, always seeking new information. Challenge your assumptions and adapt your approach. The more you learn, the better equipped you'll be. Investing requires active participation and ongoing education. Stay curious, stay informed, and never stop learning. Start today, not tomorrow. The best time to plant a tree was 20 years ago. The second best time is today. Even small investments can grow over time. The most important thing is to take that first step and get started. Share the wealth of knowledge. Talk to your friends and family. Financial security is within reach. Together we can achieve financial freedom.